That is interesting that even REITs that are based upon real estate correlate with the public markets.
Right.
Yeah, I've never seen them as anything but a stock,
Right.
no matter what they call them, because
I
that's
call
how
them
they
real
act.
estate sausages, right? It's like if you want a steak, buy a steak. You want a piece of real estate, buy a piece of real estate. You want a sausage, buy a sausage, and that's what they are. They're real estate sausages.
Yeah, it's a good way to put it there. Um, so when evaluating opportunities, which I think is um, in public markets, I don't think people spend any time other than people like Warren Buffett really evaluating what they're investing
So
in.
true.
So how do you distinguish between asset risk and operator risk, which I think in private markets, that's a very important question, and you really need to understand that.
Yeah. Well, the first way to mitigate risk is to make sure you have different buckets. So I recommend, right, have a public market bucket, have a bond bucket, right? But then have a private real estate bucket, have a private credit bucket, have a natural resources bucket, that you're putting in private investments across the spectrum. That's number one. And number two is doing operator due diligence, right? Those are the two ways that you mitigate your risk in privates. Is first of all, manage your allocation strategy. Never put more than 5% in any one deal. I don't care how much you love it. You put any more than that, you're taking what I call the bet, right? You're making the bet. Don't make the bet. The big boys don't make the bet, right? They're playing statistics. They're playing the numbers game. They're not trying to have a crystal ball. None of them are trying to have a crystal ball of what's going up and what's going down. They're just trying to say, I'm spreading my risk around. I'm going to make good, solid investments, knowing that some are going to go up and some are going to go down. And so the managing your buckets is first and foremost. And second is picking great operators, right? The difference between operators and the public side is not pronounced. And there's one of my favorite charts in the book is from JP Morgan and shows the best REIT operators and the worst REIT operators. There's only like 1.5 percentage points of return difference between the two of them, right? They're pretty much, they're all vanilla. They're all the same. The great ones are doing mediocre and the not great ones are doing mediocre. On the private side, the best operators are doubling the returns of the public guys, double. Mm-hmm. The worst guys are losing money. Right. So they're making 0% returns or negative returns. Mm-hmm. And so the way you differentiate yourself, it's almost impossible. People try to beat the public markets all the time and no one can do it really. But in the private markets, you absolutely can beat the market. And the way you beat the market is by doing better due diligence and better underwriting of these private operators. And you can absolutely beat the market. Anyone who does great operator selection consistently in the private market is going to kill it.
Absolutely.